It's a feeling I think most investors know, maybe all too well. You look at your portfolio, right, and some things are up. Doing great. You see those nice green numbers.
Yeah, the winners. Feels good.
Exactly. But let's be real. It's never all winners, is it? Chances are you've got some positions sitting there, underwater, showing red, unrealized losses.
Happens to everyone.
And it could be, frustrating. Just seems like dead money. But what if those losses, those disappointments, could actually do something for you?
Interesting angle.
What if they could, say, help cut the tax bill you owe on the winners? I mean, it sounds a bit counterintuitive, almost like financial magic.
Yeah, it can sound like that. But it's definitely not magic. It's a real strategy, a core tactic, actually, in smart portfolio management, especially here in the U.S. It's called tax loss harvesting.
Tax loss harvesting. And that is exactly what we are diving deep into today.
Yeah.
Welcome, everyone, to a deep dive into tax loss harvesting in the U.S. We're going to break it down, what it is, how it works, and maybe most importantly, how to use it right. Well, avoiding the traps.
Because there are definitely traps.
Oh, I bet. And we're digging into some key sources today. We're going straight to the official stuff, IRS Publication 550, that's Investment Income and Expenses. Chapter 4 is really key here, laying out the rules for sales and trades.
Right, the foundational rules. And we'll also weave in some practical perspectives, kind of how people are actually using this strategy out there.
So our mission today, pretty clear. We want to unpack this whole thing, give you a really solid understanding. We'll start with the basics, how gains and losses even work for taxes. Then define tax loss harvesting, really get into the nitty-gritty of the wash sale rule. Sounds important.
Oh, it's critical. Absolutely critical.
Because we'll tackle that, and then explore practical ways to do it. And like you said, the pitfalls, what not to do.
Exactly. The goal is, by the end of this, you should feel much more comfortable thinking about whether this strategy, TLH, fits into your own investment picture and your tax planning.
All right. Sounds like a plan. Let's get started. We need that foundation first, right? Any talk about tax loss harvesting, it has to start with just understanding capital gains and losses.
Absolutely fundamental.
Yeah.
And the IRS guidance, Pub 550, it's very clear. When you sell or trade investment property, the very first step is figuring out if you made money or lost money, a gain or a loss.
Okay. And how do you figure that out?
Well, you take the amount you realize from the sale.
Yeah.
What you get. And then you subtract your adjusted basis in the property.
Amount realized minus adjusted basis. Got it.
Oh.
Now, investment property. What falls under that umbrella?
Yeah, good question. Think broadly, but specifically in this tax context. So the usual stuff. Stocks, bonds, mutual funds, ETFs, things you hold hoping they'll appreciate. And really important these days, it also includes digital assets. So cryptocurrencies, NFTs. The IRS views those as property for tax purposes.
Okay, so Bitcoin, Ethereum, if you're holding it as an investment, that counts.
Right. What we're generally not talking about here is, say, property you use in your business, like equipment. That follows different rules.
Got it. So buying Tesla stock, hoping it goes up. Investment property.
No.
Selling the lawnmower you use for your landscaping business. Not investment property for these rules we're discussing now.
Exactly. Clear distinction.
Okay, so you mentioned two key terms there from the IRS, amount realized and adjusted basis. Let's break down amount realized first. What's included in that?
So the amount realized is basically everything you get from the buyer. Usually it's cash, right?
Yeah.
But it could also be the fair market value of, say, other property or even services you get as part of the deal. But, and this is important, you get to subtract certain costs.
Like what?
Your selling expenses. Things directly tied to making the sale happen. Brokerage commissions are the big one.
Ah, okay.
Transfer fees, maybe even advertising costs if you sold it yourself somehow. Those reduce your amount realized.
Okay, so if I sell some stock for, say, $20,000 cash, but the broker hits me with a $50 commission, my amount realized isn't the full 20 grand.
Nope. It's $19,950 in that case. It's the net amount you walk away with after those direct selling costs.
Makes sense. It's what you actually pocket, more or less.
Exactly. Now, the other piece of that equation is your adjusted basis.
Right. The basis. That's usually what you paid for it, isn't it?
Generally, yes. Your cost is the starting point. But notice the word adjusted. That initial cost can and often does change over time because of different events.
Okay. What kind of events would adjust your basis, make it go up or down?
Well, think about stocks. Stock splits, for example, they change your per-share basis.
Right. A 2-for-1 split means you're basis per share gets cut in half.
Exactly. Or if you get dividends and you reinvest them automatically, those reinvested dividends typically increase your basis in the shares you own.
Because you're essentially buying more shares with that dividend money.
Precisely. Same idea. With mutual funds, reinvested dividends and capital gain distributions usually bump up your basis. Pub 550 also talks about situations where you didn't just buy it, like gifts.
Okay, what about gifts?
If someone gives you stock, your starting basis is usually whatever their basis was, the donor's basis. But there are some tricky rules if the stock was worth less than the donor's basis when they gave it to you, especially if you later sell it at a loss.
Oh, wow. Okay.
And inheritances are different too. If you inherit property, your basis is typically stepped up, or sometimes down, to the fair market value on the date the person passed away.
So you could inherit stock worth way more than what the person originally paid, and your basis starts at that higher value.
Often, yes. That step up in basis is a huge benefit. But you see why adjusted is key. The original cost isn't always the final number.
Absolutely. And the IRS specifically mentioned digital assets again here.
They did. They really emphasize record keeping for crypto and such. To figure your gain or loss, you need the date, the time, how many units, the fair market value in dollars at that time, and crucially, your basis.
And getting the basis for gifted crypto sounds like it could be tough.
It can be.
Yeah.
Pub 550 notes that if you get digital assets as a gift, the basis rules can be complicated, and if you don't have proof of the donor's basis, your basis for calculating a loss might even be zero in some scenarios.
Wow, okay, so lesson learned. Tracking your basis, especially with reinvested dividends, gifts, inheritances, digital assets, it's absolutely critical. It's not just remembering the purchase price.
It's fundamental. Get the basis wrong, you get the gain or loss calculation wrong. Simple as that. Realized minus adjusted basis. If the result is positive, capital gain. Negative, capital loss. That's the core calculation.
The calculation done, gain or loss figured out. Now, there's another layer the IRS brings in, right? Something about how long you owned it, the holding period.
Yes, exactly. The holding period. This is super important because it affects how your gains and losses are taxed.
How does the IRS define the periods?
Two main buckets, short-term and long-term. Short-term is if you held the investment for 1 year or less.
Okay, a year or less.
Long-term is if you held it for more than 1 year. And the way you count is specific. You start counting the day after you acquire it, and you count up to and including the day you sell it. Day 0 is the acquisition day.
Got it. More than a year is the key for long term. And why does this matter so much? Taxes, I assume.
Taxes, exactly. It dictates the tax rate on your gains, and also how gains and losses get netted against each other. Short-term capital gains. Those are generally taxed at your ordinary income tax rate.
Which is usually higher for most people.
Often, yes. Could be significantly higher than the long-term rates. Long-term capital gains, on the other hand, get preferential treatment.
Lower rates.
Yep. Currently, 0%, 15%, or 20% at the federal level, depending on your overall taxable income. Plus, for higher earners, there might be that extra 3.8% net investment income tax, the NIIT, on top.
Okay, so holding for more than a year can save you a decent chunk in taxes if you have a gain.
Definitely. And losses also keep their character short-term or long-term. This matters for offsetting.
How does the offsetting work? Do short-term losses cancel out short-term gains first?
That's exactly right. The process is, first, you net all your short-term gains and losses together for the year. Find the net short-term result.
Okay.
Then you do the same for all your long-term gains and losses. Find the net long-term result.
Right.
Then if you have, say, a net short-term loss and a net long-term gain, you can use that short-term loss to offset the long-term gain. Or vice versa. The rules specify the order, but basically losses in one bucket can offset gains in the other after you've netted within each bucket first.
Okay, that makes sense. You sort them out by holding period first, then see how they net out overall.
Precisely. You arrive at your overall net capital gain or loss for the year.
All right, the stage is definitely set now. We've got gains, losses, basis, amount realized, holding periods. Check, check, check. Now let's bring it home to the main event, tax loss harvesting. How do these fundamentals connect to that strategy?
Okay, so building directly on all of that. Tax loss harvesting, or TLH, is basically the deliberate act of selling an investment that's currently worth less than what you paid for it, less than your adjusted basis.
You're intentionally selling at a loss.
Intentionally realizing that capital loss, yes. And the reason you do it, the goal, is to use that realized loss to offset other capital gains you might have realized elsewhere in your portfolio during the same year.
Okay. So Instead of just sitting on that losing stock, hoping it comes back someday,
Right.
you pull the trigger, sell it now, capture the loss on paper, and use that loss to reduce the taxes you'd otherwise owe on your winning investment.
You got it. It's about making that unrealized loss work for you, turning it into a tax-efficient realized loss.
Smart. And does the benefit stop there? Just offsetting gains in the same year?
No, and this is where it gets even more powerful. As hinted at in industry materials, and based on the IRS rules about loss limits, if your total capital losses for the year are more than your total capital gains,
you have a net capital loss overall.
Yep. Exactly. You're not just stuck with those extra losses. The IRS lets you deduct a certain amount of that excess loss against your other income, like your salary or wages, your ordinary income.
Oh, really? How much?
The limit is currently $3,000 per year. Or if you're married filing separately, it's $1,500 per year.
So if I have, say, $10,000 in gains and $15,000 in losses this year, I net out to a $5,000 loss.
Right.
I can use $3,000, that $5,000 loss, to directly reduce my taxable income from my job.
That's correct. It's a direct reduction against income that would otherwise be taxed at potentially higher ordinary rates. Big benefit there.
Wow. Okay. And what happens to the other $2,000 of loss in my example? Is it just gone?
No, that's the other great part. It's not lost. Any excess capital loss beyond that $3,000 annual deduction limit, you get to carry it forward.
Carry forward to next year.
To next year and the year after that and the year after that, indefinitely, until it's all used up.
So that leftover $2,000 loss can be used to offset gains next year. Or maybe take another $2,000 deduction against ordinary income next year if I don't have gains.
Exactly. In future years, you use the carryover loss first to offset any capital gains, and then, if there's still loss left over, you can take up to the $3,000 deduction against ordinary income again until the carryover is exhausted.
That carryover feature sounds incredibly valuable. A big loss harvested today could keep giving you tax benefits for years down the road.
It absolutely can. It provides ongoing tax relief. So yeah, the core benefit is lowering capital gains tax now, maybe getting that small ordinary income deduction, and potentially banking losses for future tax savings.
Oh, it sounds really good, which, in finance usually means there's a catch, a big but.
There usually is, isn't there? And in this case, the big but, the absolute showstopper if you mess it up, is the wash sale rule.
The wash sale rule. Knew it sounded important.
It's the linchpin. If TLH is the engine, the wash sale rule is a brake you have to understand. The IRS put it in place specifically to stop people from selling something for a quick tax loss and then immediately buying it back, basically staying in the exact same position.
Okay, so prevents claiming a loss on paper when you haven't really changed your investment position.
Precisely. Pub 550, Chapter 4, under wash sales, lays it out.
So give it to us straight from the source. What does the rule actually say? What can't you do?
Okay, the rule says you cannot deduct a loss from selling stock or securities if, and here's the key part, within a period starting 30 days before the sale and ending 30 days after the sale, you do any of the following. 1, you buy substantially identical stock or securities. 2, you acquire substantially identical stock or securities in a fully taxable trade. Or 3, you acquire a contract or an option to buy substantially identical stock or securities.
Wow, okay, so it's not just buying it back. It's acquiring it in almost any way, even in an option.
Yeah.
And that window, 30 days before, 30 days after, plus the sale day itself.
That's the one. It's a 61-day window in total. A full month looking back and a full month looking forward from the date you sell at a loss.
That's a pretty long time. And that phrase, substantially identical, that sounds like where the wiggle room, where the confusion might be. What does the IRS mean by that? Is it just any tech stock if I sell a tech stock?
Yeah, that's the crucial interpretation point. And the IRS, well, they don't give a giant dictionary definition, but the examples and how it's generally applied point to a pretty narrow meaning.
Okay.
The example in Pub 550 is clear. Selling XX Corporation stock at a loss and then buying back XX Corporation stock. Classic wash sale. It really means shares of the exact same company or bonds from the same issuer with the exact same maturity and coupon, or shares of the exact same mutual fund or ETF.
So Apple stock is Apple stock. Selling Apple and buying Microsoft is okay, even though they're both big tech.
Correct. Selling Apple, AAPL, at a loss and buying Microsoft, MSFT, is not a wash sale. They are different companies, different securities, not substantially identical.
That's a hugely important distinction. It's about the specific security, not just the sector or type. So you sell security A at a loss. You just cannot buy back security A or an option on it within that 61-day period.
That's the heart of it.
What happens if you slip up? If you do violate the rule, Let's say you sell, take the loss, and then maybe out of habit, you buy it back 15 days later.
Okay, so if you trigger the wash sale rule, the loss you thought you harvested on that initial sale, it's disallowed, gone. For that tax year anyway.
Disallowed, so you just can't claim it on your tax return this year.
Correct. You don't get that immediate tax deduction you were aiming for. But, and this is important, the loss isn't just wiped off the face of the earth forever.
Oh, what happens to it?
The IRS guidance explains that the disallowed loss amount gets added to the cost basis of the replacement shares, the substantially identical ones you bought within that 61-day window.
Ah, okay, so let's walk through that. The loss is denied now, but it increases the basis of the new shares I just bought, which means when I eventually sell those new shares, my taxable gain will be smaller or my loss will be bigger because their starting basis was higher.
Precisely. You nailed it. It effectively pushes the tax benefit of that original loss into the future to whenever you finally sell the replacement shares. Pug 550 has that XX Corporation example that illustrates this basis adjustment perfectly.
So it's a deferral, not a complete elimination of the loss benefit. But crucially, you lose the immediate tax savings you wanted from harvesting today.
Right, which kind of defeats the main purpose of TLH in the current year. That's why avoiding the wash sale is absolutely job number one.
Okay. And this naturally leads us to the workaround, right?
Okay.
The strategy people use to get the loss and stay invested. The similar but different approach.
Exactly. Since the rule hinges on substantially identical, the smart play is sell investment A at a loss, realize that loss for tax purposes, and then immediately reinvest that money into investment B.
Where investment B is.
Investment B is something that gives you similar market exposure, fits the same role in your portfolio, but is different enough from investment A that it's not considered substantially identical.
Can you give a really concrete example? Like with ETFs?
Sure. Classic example. Let's say you own the Vanguard S&P 500 ETF, ticker VOO, and it's down, you've got an unrealized loss.
Okay.
You sell VOO to harvest that loss. Now, you want to stay invested in U.S. large caps, right? So to avoid the wash sale, you could immediately take that cash and buy, say, the iShares Core S&P 500 ETF, ticker IVV.
Ah, different provider, same index.
Exactly. Or maybe the SPDR S&P 500 ETF, SPY. They all track the S&P 500, but because they're issued by different companies, they are generally considered different securities, not substantially identical. So boom, you've got your tax loss booked and you're still holding S&P 500 exposure.
That makes perfect sense. That's a very common technique. Switching providers.
Yeah.
What about switching to a slightly different index altogether?
Yep, you could do that too. Maybe you sell a total U.S. stock market ETF at a loss. You could potentially buy back into just an S&P 500 ETF, or maybe a large cap value ETF, or a large cap growth ETF, depending on what fits your strategy.
Still related, still maybe large cap U.S. stocks, but tracking a different underlying basket of securities.
Right. The key is creating that distinction so it's not substantially identical. You get the tax loss, you sidestep the wash sale penalty, and you stay invested broadly according to your plan.
It definitely requires some thought, though, to pick a replacement that keeps your allocation on track but is different enough.
Yeah.
And you mentioned the IRS guidance says the rule doesn't usually apply to dealers, but it does apply to short sales.
Yes, those details are in there. For most individual investors, though, the main takeaway is that 61-day window and really understanding what substantially identical means for your holdings. Avoiding that rule is just non-negotiable if you want TLH to work.
Okay, absolutely clear. Foundation laid, strategy defined, huge warning sign around the wash sale rule firmly planted. Now let's get practical. Beyond just knowing the rules, what are some tips or maybe more advanced strategies for actually doing tax loss harvesting effectively? Industry folks often talk about timing.
Yeah, timing definitely plays a role. I mean, technically you can harvest a loss anytime an investment drops below your basis,
Cool.
but doing it near the end of the tax year, say in Q4, maybe November or December, often makes strategic sense.
Why then specifically?
Well, by late in the year, you usually have a much clearer picture of your entire tax situation for that year. You know what other capital gains you've already realized from selling winners earlier.
So you know how much gain you need to offset.
Exactly. You can be more precise about how much loss harvesting would actually be beneficial. You're not just harvesting blindly, you're targeting a specific amount of gain offset.
That makes sense. And what about market conditions? Is there a good time market-wise to look for losses?
Absolutely. The practical advice often points to market dips or corrections as prime TLH opportunities.
When things are generally going down.
Right. When the market as a whole, or maybe a specific sector you're in, takes a hit, chances are more of your positions will dip below your cost basis.
So more potential losses become available to harvest.
Exactly. It's kind of counterintuitive, but a market downturn, while maybe not fun to watch, can actually unlock these valuable tax-saving opportunities, especially if you have realized gains elsewhere that need offsetting.
Looking for the silver lining in the red ink, then?
Sort of, yeah. And this ties in really nicely with something else investors should be doing anyway, portfolio rebalancing.
How do TLH and rebalancing fit together?
Well, rebalancing usually involves selling positions that have grown too large in your portfolio to get back to your target allocation. Selling winners often means realizing capital gains. So if you combine rebalancing with TLH, you can strategically sell some winners as part of your rebalancing, and at the same time sell some losers to harvest losses. Those losses can then help offset the gains from the rebalancing sales. It makes the whole rebalancing process much more tax efficient.
Killing two birds with one stone, tax-wise. That sounds like a really smart integration. It's not just random selling. It's part of a larger discipline.
It absolutely should be. And that leads to a really critical piece of practical advice. TLH shouldn't be a one-off trick you pull out of a hat. It really should be an integrated, ongoing part of your overall wealth management strategy.
Not just something you think about in December if the market tanked.
Right. It needs to fit with your long-term goals, your tolerance for risk, your whole financial plan. And critically, you should avoid selling something just because it's down if you still fundamentally believe in it for the long haul.
Yeah, the tax tail wagging the investment dog problem.
Exactly that phrase. Your investment thesis, your strategy, that should drive the bus. TLH is just a tool to make the execution of that strategy more tax smart. Don't make bad investment decisions just to save a few bucks on taxes now.
That's a super important point. Don't compromise your long-term strategy for a short-term tax one. Now, you mentioned earlier that the IRS rules get more complex for different kinds of investments. That impacts how you calculate everything for TLH.
It really does. Basic stocks, simple bonds, the basis calculation is usually straightforward cost plus reinvestments adjusted for splits, etc. But other things, they have layers.
We talked about digital assets needing careful tracking. What else does Pub 550 highlight that investors doing TLH need to be aware of?
Options are a big one. How you treat gains or losses from options depends heavily on what happens. Is the option sold, exercised, or does it just expire worthless? Generally, if the underlying property of the stock the option is for would be a capital asset for you, then gain or loss on the option transaction is usually capital. But the specifics matter. For instance, if you write a put option, someone exercises it, and you're forced to buy the stock, the premium you received for writing that put, it reduces your basis in the stock you just bought.
So that affects the potential gain or loss when you eventually sell that stock.
Exactly. Understanding those mechanics is crucial if you're trying to harvest losses involving options.
Definitely adds complexity. What else?
Straddles. These are tricky. A straddle is basically holding offsetting positions like a call and a put on the same stock where the values tend to move in opposite directions.
Okay, they're designed to limit risk, maybe.
Often, yes. But the IRS has specific rules, loss deferral rules, to prevent people from realizing a loss on one leg of the straddle while holding on to an unrealized gain on the other offsetting leg.
So you can't just cherry pick the loss?
Not easily. Pub 550, Chapter 4 again, goes into detail about how positions are presumed offsetting, and there are special rules for certain types of contracts often used in straddles, like Section 1256 contracts, futures, certain options. These have their own mark-to-market rules. Figuring out if you even have a deductible loss from a straddle in the current year is way more involved than selling simple stock.
Wow. Okay, so options and straddles definitely require careful handling for TLH. What about bonds? Any special cases there?
Yeah, bonds that aren't just plain vanilla. Think about bonds bought with original issue discount, OID, or bonds bought on the secondary market at a discount bonds.
OID. That's like zero coupon bonds, right?
Often, yeah. With OID bonds, you generally have to include a portion of that discount as interest income each year, even if you don't receive cash. And that amount you include in income. It increases your basis in the bond over time.
So your basis isn't just what you paid.
Correct. It's your cost plus the OID you've already recognized as income. And for market discount bonds bought for less than face value after they were issued, there are rules about treating some of that discount as ordinary income when you sell or redeem the bond, which affects your capital gain calculation. Again, basis isn't simple cost. You need to track these adjustments to know your true gain or loss for harvesting.
Man, the type of asset really, really matters for getting the numbers right. Basis calculation seems key. Speaking of which, what about choosing which shares to sell if you bought the same stock or fund multiple times at different prices? Does the IRS let you pick?
Yes, and this is a really powerful technique for maximizing TLH, especially with stocks or mutual funds where you have multiple purchase lots. It's called the specific identification method.
Specific identification, how does that work?
If you use specific ID, you get to tell your broker exactly which shares you want to sell, based on when you bought them and what you paid.
So let's say I bought 100 shares of XYZ at $50, later bought another 100 shares at $40, and now it's trading at $45. I can choose.
Yes, using specific ID, you can instruct your broker, sell the 100 shares I bought at $50.
And if I do that, I sell at $45 shares with a $50 basis. I realize a $5 per share loss.
Exactly. Even though your other lot, the one bought at $40, actually has an unrealized gain. Specific ID lets you pinpoint and sell the highest cost shares first to generate the largest possible tax loss.
That's very strategic. How do you make sure that happens?
You have to properly identify the specific shares to your broker at or before the time of the sale. Contemporaneous instructions are key.
Okay. What's the alternative to specific ID? You mentioned average basis.
Right, the average basis method. This is often the default method, especially for mutual fund shares bought over time, and sometimes for stocks, depending on when they were acquired, these covered securities rules.
And if I use average basis?
Then you don't get to pick. Your basis for any share you sell is simply the average cost of all the shares you own in that particular fund or stock.
So in my XYZ example, my average basis would be $45, $50 plus $40 too. If I sell at $45,
you'd have zero gain or loss using the average method in that simplified case, even though you could have harvested a loss using specific ID on the $50 lot.
Big difference. So choosing the right basis method before you sell is really important for TLH.
Absolutely critical. Average basis is simpler, maybe, but specific ID gives you much more control for tax optimization. Pub 550 talks about how to elect these methods and sometimes how to revoke them, but the choice has direct consequences for your TLH results.
Clearly, yeah. Knowing your assets, the specific rules for them, and how you're calculating basis, it's all fundamental for doing TLH right.
Okay, we've gone through the mechanics, the strategies, the nuances. Let's shift to the dark side, the pitfalls. What are the big mistakes people make? What should listeners be really careful about?
Well, one risk that sometimes gets overlooked, mentioned in industry stuff, is not thinking through the impact of tax rates both now and potentially later.
How so?
The immediate win from TLH is saving tax at today's rates, right? If you offset a long-term gain, you save at those 0.1520% rates. Offset short-term, you save at your higher ordinary income rate. Okay, the value depends on what kind of gain you offset in your current tax bracket.
Exactly. If you're in the 0% long-term bracket now, the immediate saving isn't huge. But here's the other side. When you harvest a loss and buy a replacement asset, even a similar but different one, that replacement often starts with a lower cost basis because you didn't have the disallowed loss added back like in a wash sale. Or if you did have a wash sale, the basis is higher, but you lost the immediate benefit. Point is, you're often setting yourself up for potentially larger capital gain when you eventually sell that replacement asset way down the road.
Right.
Yeah.
You get the tax break now, but you might pay more tax later because your future gain will be bigger.
Precisely. It's often a tax deferral game. Is the tax saved today at today's rates worth more than the potentially higher tax paid years from now, possibly at different future tax rates?
Plus inflation eating away at the value of the future tax payment.
Right. It's usually a net positive, especially with carry forwards. But you should consider the long-term picture. Don't just focus on the immediate gratification of the tax saving without thinking about the future tax liability you might be creating or shifting.
That's a sophisticated point. And it ties right back into that other huge pitfall we already touched on. Letting taxes mess up your actual investment strategy.
Cannot stress this enough. It is probably the biggest strategic mistake. Selling a great investment you believe in just because it's temporarily down solely to get a tax loss that can seriously harm your long-term returns.
You might miss the rebound.
You might miss the rebound if you sit in cash. Or you might be in a replacement asset that doesn't perform as well during that rebound. Your decisions about what to own and when to own it should be driven by your investment goals and research, not just by the tax code. TLH should support your strategy, not dictate it.
Solid advice. Don't let the tax tail wag the investment dog. Okay, so strategic pitfalls covered. What about the rule-based pitfalls? The number one technical mistake.
Oh, easy. Violating the wash sale rule. Hands down.
We keep coming back to it.
Because it's that important. Messing it up means the loss you work to harvest is just disallowed for the current year. Poof. Immediate benefit gone.
And avoiding it requires careful tracking.
Meticulous tracking. And not just in the account where you sold the loser. You have to track across all your accounts.
All accounts? What do you mean?
I mean, your taxable brokerage accounts, your spouse's taxable accounts if you file jointly, and crucially, your tax-advantaged accounts like IRAs and potentially 401ks, depending on investment options.
Wait, seriously, if I sell, say, VOO at a loss in my taxable account, I can't buy VOO back in my IRA within that 61-day window.
That is absolutely correct, and it's a trap people fall into all the time. Buying the substantially identical security back in an IRA does trigger the wash sale rule for the loss in your taxable account.
Oh.
And worse, unlike buying it back in another taxable account where the disallowed loss at least gets added to the basis, when you buy it back in an IRA, that basis adjustment doesn't happen. The tax benefit of that loss is effectively lost forever, or at least significantly deferred until retirement distribution.
Oh my gosh, that's brutal. So selling intaxable, buying an IRA, it was wash sale, loss denied, no basis adjustment benefit.
Exactly. Same goes for selling in your account and your spouse buying it back in theirs within the window. You have to look across all related accounts.
That adds a whole other layer of complexity and risk. Diligence is key.
Absolutely. Which leads directly to the next pitfall, just plain incorrect calculations.
Getting the numbers wrong.
Yeah. Mistakes in figuring your basis, especially with those complex assets like options or bonds with OID, or maybe miscalculating your holding period, short versus long term, any of that can lead to you reporting the wrong gain or loss amount.
And the IRS doesn't like that.
No, they don't. Pub 550 details the methods and forms, but errors can lead to underpaying your taxes, which can mean penalties and interest.
Right. Accuracy matters. Which loops us back to
record keeping. It's the bedrock. Pub 550 Chapter 4 is emphatic about keeping adequate records for every investment transaction.
What exactly do they mean by adequate records?
Knowing the date you bought it, the day you sold it, your accurate adjusted basis, tracking all those adjustments we talked about, the amount you realized, sales price minus selling costs. You need all that data.
Don't brokers track most of this now on the 1099-B forms they send?
They do, especially for covered securities bought more recently. The 1099-B reports proceeds and often reports basis. But, and it's a big but, the basis reported by the broker might not be correct for older shares, non-covered securities, or shares you transferred in from another firm, or complex assets where they don't know all your adjustments. You are ultimately responsible for reporting the correct basis on your tax return.
So you can't just blindly trust the 1099-B basis number. You need your own records to verify or correct it.
Exactly. Especially if you're using specific identification, the broker might report average basis unless you gave clear instructions. You need your own robust system to track purchases, sales, basis adjustments like reinvested dividends or return of capital, especially for TLH purposes.
Meticulous record keeping, non-negotiable. Got it.
Absolutely.
Okay, so let's say you've navigated all this. You followed the rules, harvested some losses, calculated everything correctly, avoided the wash sales, kept good records. How do you actually report this stuff to the IRS on your tax return? What forms are involved?
Right, the reporting part. It primarily involves two main forms for most people. First is Form 8949.
8949.
Okay, think of Form 8949, Sales and Other Dispositions of Capital Assets, as your detailed transaction list. This is where you list out each individual sale you made during the year. You put down what you sold, the date you bought it, the date you sold it, the sales price, amount realized, and your cost basis.
So line by line for each sale.
Pretty much.
Right.
And there are columns and codes on Form 8949 to indicate things like whether the basis was reported to the IRS by your broker, and importantly, to make adjustments like if you have a wash sale loss disallowed, you'd note it there.
Okay, so 8949 is the detailed worksheet. Where does that info flow next?
The totals from all your Form 8949s then get carried over to Schedule D, Form 1040.
Schedule D. Heard of that one?
Yep, Schedule D, Capital Gains and Losses, is the summary form. It takes the totals from Form 8949, separating them into short-term transactions and long-term transactions. Schedule D is where you calculate your net short-term gain or loss for the year and your net long-term gain or loss.
And this is where that $3,000 loss deduction limit gets figured out too.
Exactly. Schedule D nets the short-term and long-term results together to find your overall net capital gain or loss. If it's a net loss, Schedule D walks you through calculating how much of that loss you can deduct against ordinary income this year up to that $3,000 limit or $1,500 MFS.
And the carryover part.
Schedule D instructions include a worksheet, the capital loss carryover worksheet that helps you figure out how much of any remaining loss gets carried forward to next year.
Okay, so Form 8949 for the details, Schedule D for the summary and the final netting and deduction calculation. What about those really complex things like the Section 1256 contracts or straddles?
Good question. Pub 550 mentions those often have special treatment. Gains and losses from Section 1256 contracts, for example, usually get split 60% long-term, 40% short-term, regardless of holding period, and are often reported first on a different form, Form 6781.
Form 6781.
Right. Gains and losses from Section 1256 contracts and straddles. The results from there then flow to Schedule D. Straddle loss deferrals also get calculated before the final number sheet Schedule D. So yeah, depending on what you trade, other forms might come into play first.
Definitely sounds like a multi-step process needing real accuracy across potentially several forms.
It absolutely is. Getting the reporting right is just as important as getting the harvesting strategy right if you want the benefits and want to stay compliant.
Wow. We have covered a ton of ground in this deep dive. Seriously, from the absolute basics, capital gains, losses, bases, holding periods, all the way through the mechanics of tax loss harvesting, the huge importance of that wash sale rule, ways around it, practical tips, and all those potential pitfalls. Complex assets, record-keeping reporting.
It's a lot for sure.
It really is. But it's clear that TLH, when you do it correctly, when you understand the rules, it can be a genuinely valuable tool for managing your investments and, keeping more of your money away from Uncle Sam.
It really can. It offers tangible benefits, reducing taxes now or banking losses that provide value down the road. It's a legitimate strategy.
Okay, so as we wrap this up, let's just quickly recap the absolute must-know takeaways. Using losses to offset gains. Powerful.
But it all hinges on knowing and following the rules, especially, say it with me,
the wash sale rule. That 61-day window, understanding substantially identical, absolutely critical.
Nailed it. And remembering the workaround swapping into similar but not identical assets.
Right. Timing can help, especially near year-end. But the golden rule.
Don't let the tax tail wag the investment dog. Integrate TLH with your overall strategy.
And underpinning all of it.
Meticulous records. Accurate calculations, know your basis, get the numbers right.
Perfect summary. Now, as you, our listener, think about all this, about your own portfolio and taxes, here's maybe a final thought to chew on. We've talked a lot about the mechanics and benefits of TLH. It's about managing tax outcomes. But does the act itself, constantly scanning for losses, reacting to downturns specifically to harvest, does that risk subtly changing how you feel about your investments? Could it maybe introduce an emotional element or a short-term focus that might, just maybe, distract from the patient, disciplined mindset needed for really long-term compounding?
That's a deep question. How do you keep that balance?
Exactly. How do you make sure that chasing short-term tax efficiency doesn't somehow undermine the long-term health and strategic vision you have for your wealth? It's a fine line, isn't it?
It really is. Finding that balance is maybe one of the toughest but most important parts of being a successful investor over the long haul.
Absolutely. Well, look, navigating these rules, especially with all the nuances for different assets and the strictness of things like the wash sale rule, it can definitely feel complex.
No doubt.
The good news is the IRS does provide a lot of resources. IRS.gov has a ton of information, and publications like 550, which we drew on heavily today, are available there. You can search for specific terms like wash sales or basis of investment property.
Those publications are dense, but they are the source. And given that everyone's situation is unique, your income, your specific investments, your state tax laws, and tax laws themselves can change.
Right.
While this deep dive hopefully give you a strong foundation, it's not personalized advice. For help applying these concepts to your specific circumstances, talking to a qualified financial advisor or a tax professional is really highly recommended.
Couldn't agree more. Get informed first, that's what we aim for today, but then get professional guidance to make sure you're doing it right for you.
Yeah.
Smart move.
Well, thank you so much for joining us on this deep dive into tax loss harvesting. We really hope you feel more confident, more knowledgeable about this powerful strategy and how it might or might not fit into your own investment world.